Hello, everyone. Thank you for joining. We're ready to get started. We're excited for a great conversation today on this Coalition Greenwich webinar, The Evolution of Credit Portfolio Management. I'm Kevin McPartland. I'm the head of Market Structure and Technology Research here at Coalition Greenwich, and I will be your moderator today. Before we get started, a couple of housekeeping items. Questions are welcome. Please type them in the question box in the system, and we will answer as many as we can. If we don't get to them, we will do our best to follow up after. After the event, you'll be asked to participate in a brief survey to let us know what you liked and didn't and what you'd like to see from us in the future. We do absolutely look at those results, so please take the time. And then lastly, the webinar is being recorded. We will send around that recording with a write-up about a week after the event, so keep an eye out for that. We have a really fascinating panel assembled today with some really great viewpoints. It's been such an interesting market, so with that, we'll just jump right in. So we're going to start macro, and then we'll get a little bit deeper. We'll get into technology and such as we go, but let's start macro. Scott, we'll start with you if it's okay. Can you help us to understand a little bit the current credit cycle, which has been certainly at least unprecedented for the last 10 years or so, what impact that's had on portfolio construction, leverage finance, and just really the day-to-day of your job over the last year?
Certainly. Good to be with you, Kevin, as well. I'm Scott Diorsi, a loan portfolio manager at Putnam Investments. And you're absolutely right. 2022 has been a very, very challenged year for the credit markets. And in many ways, it's been the reverse or the unwind of all the tailwinds that we experienced in 2021. So, for example, to put that into a little bit of perspective, we exited 2021 at a credit default rate that was less than 1%. It was really, really suppressed. We're going to be exiting 2022 with a default rate around 1.5%, 2%, but more importantly, all of the forward expectations is that we'll move into somewhere around a 3.5%, 4%, maybe even 5% credit default rate. So that's a very significant shift throughout the year in terms of the credit outlook. And in terms of performance, the credit markets, not unlike what we've seen in the equity markets, have suffered losses, but they've really varied quite significantly from fixed income traditional markets like investment grade and high yield, where you're down somewhere between 10 and 14%, and then you get more specific to today's topic in the private credit space, where, for example, the leveraged loan market is only down 30 basis points, and we can get into the weeds as to why that is. Largely being a floating rate asset class, it's really suffered much, much less than some of those other.
And then great, I mean, from Alina, from your perspective, you work with a number of clients. What has been your sort of experience over the past year as this credit cycle has emerged?
Yeah, thanks, Kevin. Alina Gok, I head our credit solutions business within S&P Market Intelligence. We've seen an explosive growth as well. We've discussed this actually recently at the Opal CLO Summit Conference. We've seen the growth really from all angles on the broadly syndicated side and in the private credit. We're seeing institutions getting into this market that historically have never been in this market. So that presents, additional challenges when people are launching their platforms and looking to scale their technology and their teams. I think overall, we're seeing in our managed services business over 50% growth year over year.
Great. And then Adrian, last but not least, from your perspective, right, sort of focused on the technology at the firm, was the technology able to keep up? And sort of how is the technology available sort of made the process of sort of managing this change easier or harder?
Kevin, thank you. This is Adrian Iosifescu, CIFC Asset Management, Chief Technology Officer. So, we've seen tremendous growth on the business, both public and private debt, especially the private debt. $1.5 trillion, growth, and the technology it's keeping up, barely keeping up with the business requirements. As usual, we try to find solutions without reinventing the wheel, trying to find vendors that can provide the capabilities that we're looking for. But in general, is a catch-up game that technology is in right now in this space.
Scott, from your seat, so you're the proverbial business here. Like, did you see investment opportunities that you had to pass up, and do you feel like your technology is keeping up with your your investment ideas?
I do, and as someone who's managed credit in this space on the buy side for the past 15 years, I've certainly seen a tremendous amount of innovation in the infrastructure side of it, the data capture side of it, and all of the in-house capabilities that's necessary in order to adequately manage these portfolios. And so, for the listeners and the participants on this call, because we are a private market, we don't necessarily benefit from all of the infrastructure that the public markets do. Those are regulated by the SEC and all the trade clearing requirements, etc. So we need to create that, and we need to create that through in order to accommodate, as Adrian pointed out, this is a 1.5 trillion size market. It was a fraction of that, 500 billion, not that long ago. So the technology behind it really has moved at quite a rapid clip. But it's all coming from independent parties that myself need to ensure provides adequate support for us to manage the risk in our portfolio. So thankfully, we have not been limited in what we can do, what we've been able to do in terms of the portfolio, to do any of those technological constraints. And, for example, we've completely outsourced our entire back office operation. So all of the trade flow processes and all of the data reconciliations, not just from trading with counterparties, but also all of the data that needs to go into all of these individual positions from a trustee reporting standpoint, et cetera, really has been captured and executed on a real-time basis, which allows us to stay current and not have any lag time to what our infrastructure can provide.
Yeah, and so Alina, you and your team are sort of a big part of, right, Scott mentioned about sort of it keeping and evolving. I think that the other interesting part has been this private credit versus sort of the public credit markets and being able to manage all of that in one portfolio, which, again, our research earlier in the year showed is increasingly common. So yeah, what is that process like, and has that been difficult to manage those two markets that are related but operationally can be quite different?
Yeah, absolutely. I mean, I think it starts really with the partnership with customers like Scott and Adrian, and really the broader market and other vendors to come up with solutions that are fit for purpose and fit for what we are solving for now. It really starts with the basics. As we look at the private credit side of the spectrum, we have to have common identifiers. At the loan level, we have to have common identifiers at the fund level so we can identify institutions. Those lessons that we've learned sort of from the syndicated market, I think, are very much applicable to the private debt market as well. And that alone allows us to be more efficient in reconciliation processes and system integration processes. So I think that's definitely a start. You mentioned outsourcing earlier, and we've seen a huge growth in that area as well. We manage over 800 billion of assets under management for various clients in this space. So that has been also a shift where clients are focusing their staff on sort of, driving new clients, driving risk management, risk assessment, portfolio construction, and letting vendors really take on the scalability aspects of operations. So that has been really a huge move. And overall, just adoption of cloud technology has allowed us to be more scalable, to monitor processes and monitor, year-end and quarter-end processes much better than we have been in the past. So we think adoption of those cloud tools has also helped us prepare for what the industry is experiencing today.
Yeah, cloud has come a long way in financial services in particular, and definitely opened up a lot of doors. I mean, Adrian, so you're in a place where you're integrating your internal tech with some third-party tech. Can you talk a little bit about what that process is like, how the technology offerings have changed, how your views on outsourcing have changed, enterprise, managed services, cloud, all of that? I would love to hear your thoughts.
In general, we started this journey with, full infrastructure virtualization, and then eventually the migration to the cloud. The traditional migration, which is, lift and shift, just put everything there that you had in your data center, put it in your private cloud. But that's not good enough. You want to take advantage of the cloud native capabilities to improve, performance, to improve scalability. You'll see that many of these third-party products that we, just lifted and shifted into the cloud, we had to integrate better using this, cloud native capabilities. And the other thing that would notice is that, cloud is not the end solution. Cloud is just a step in this transition. Unfortunately, I'm not going to ever lose my job because, once we're in the cloud, then we have to worry about managing the cloud, managing the resources, because it becomes like electricity. You turn the light on, but who's turning the light off? And then, the metering goes on. So, the management doesn't like that, right? Clearly, it doesn't like the fact that, we move from capital expenses to operational expenses. It doesn't like the fact that the growth is unlimited. Anybody, in technology could use the cloud, to put a new application there. Do we need that application? Is anybody questioning that? Is anybody questioning, how the resources are being utilized and paid for? So, there are new challenges. And then, the holy grail of cloud, which is interoperability between the cloud providers, which doesn't exist today, right? So if I want to have my DR into a different cloud provider, I cannot do that. I have to be bound to the cloud provider that I currently use. So there are lots of challenges. But again, the cloud allowed us to support our proprietary development and third-party products and embed everything into a technology ecosystem that provides the functionality that the user community expects.
Have there been particular business use cases for where the cloud has really made sort of new opportunities possible, or where you've really seen the most success? And I guess that's probably Alina or Adrian, that question.
No, absolutely. I mean, we've been developing an architecture that is event-driven, for example. So many of our legacy processes and applications in the industry are based on running big, heavy reports or end-of-day nightly processes to get massive amounts of data out of the system. So we're really shifting away from that and into event-driven design, where the systems downstream or upstream are able to just listen for a particular event happening, a borrowing request or certain trades, hitting a certain threshold. And so in this way, cloud technologies are allowing us to get there faster and help the managers consume data in a much more real-time basis. That's been sort of from a business benefit standpoint, but from a technology benefit, to Adrian's point, I think we've been able to really get precise on scaling the architecture in the cloud, so that we're not using the compute power when we don't need it, in times of downtime, and really able to shift significantly and bring more power online when we're in quarter and year-end processes.
And
from my, if
go
I
ahead,
may just add a little color here, from a purely technology point of view, the cloud was a great facilitator in providing the same technology ecosystem for all the users, no matter where they are, in what office around the world. So, our users in London or in Miami or in New York access the same environment, the same application. The performance is identical, meaning good.
Yeah, and I think overall it'll actually increase the speed at which the technology is adopted, right?
Correct.
We shifted from clients having to upgrade every 3 or 4 years or even longer to now being able to take quarterly and even monthly upgrades. So the time to market and new functionality has really sped up by using this technology.
I mean, Scott, from your seat, and before we get back to talking about workflow, I mean, cloud is something that we all like to talk about as market watchers and obviously as technologists. For you on the desk, like, does it matter, or are you seeing the benefits there, or is it sort of, as long as the system calculates and gives you what you need, you don't care where it comes from?
Yeah, I think it's probably more of the latter. We view it as being the referee overseeing a sort of a complex match of sorts, and if the match runs smoothly, then the referee did its job and everything is running smoothly, and play continues, and play is continuous. And it is so I'm certainly a beneficiary of that, of all of these improvements, just waves of improvements that have been made from the infrastructure side, from the technology side. And just to give you a sort of an actual example of that, part of my job is managing CLOs, which are securitized vehicles that are very, very data rich investment funds. And so they require a lot of data input and a lot of tracking, and this data can be dynamic. And we're talking about data that rolls up into 100, 125 page trustee reports on a monthly basis, right? So all of which has to be accurate. So when I first started managing these CLOs about 15 years ago, the trustee would send us a report, and we'd take a look at it and see whether or not it seemed to make sense based on maybe some spreadsheets that we were running. So now we're at the point where we know exactly what that monthly trustee, the first draft of that report, is going to look like, and we're in a position now to proactively reconcile any discrepancies we may have to that report. And we can now also take it a step further and run our portfolios through hypothetical trade simulators, all again because we're getting such good data information on a timely basis that really puts us in the driver's seat for making sure that the data information that we're getting is accurate, it's timely, because at the end of the day, it's really upon the investment manager that's making representations that what we're sending out to our investors is in fact accurate.
So that's a good segue into data. Data in private markets has been challenging. It seems like it's improved. Would love to hear about that. But then just more broadly, what data sources for you as a credit investor are most important? And what are some data sources that maybe you don't have that you would love to see?
Yeah, sure. So, the key data source for us, particularly as it relates to these securitized vehicles, are ratings. And those ratings are coming, these are corporate credit ratings, and they're largely coming from S&P and Moody's. It may also be coming from Fitch. But there's not just one rating. There are multiple ratings that need to be captured. Corporate ratings, facility ratings, recovery ratings, outlooks as they change, et cetera, because they all have effects to our ability to maintain compliance with these vehicles and the implications that they have for each one of these vehicles. So it needs to be integrated in real time, and that's probably the key data pipe for us is running these ratings. In terms of what data would you like to see, I almost can't imagine us capturing any more data than we are currently with respect to these individual loans. But I think real-time pricing is another one that's important to us. We do a decent job with it, but that's always something that you can get a little more accuracy to and a little bit more real time with. But I think for now, in terms of meeting the requirements that are included in our investor reporting mandate, we're very well suited.
Well, and what does real time mean in this context, right? Because, if we think equity markets, it's milliseconds, but that's not true in credit, right?
That's right. That's right. So we're trading, our counterparties are banks. So our counterparty, we may sell a loan from, let's say, CLO Fund 1 to Bank A. Bank A is selling that to another counterparty. There also has to be, that trade has to run through an agent bank that's keeping the ledger of all of the lenders that are in that credit agreement. In order for that trade to be processed, it needs to go out to the actual borrower or the issuer of that debt in order to get borrower's consent. So there's 5 different parties right there that is touching one trade, right? And there's a price component to that. But back to your point, as far as the pricing, because we're trading in a bilateral manner, these aren't on exchanges, they're not publicly quoted, we need to ensure that pricing is as current as we can possibly make it. And we're relying on that dealer community to provide that pricing. So we're not necessarily getting the pricing continuum in, let's say, 10 or 25 basis point increments from $1 price to another. So these are things that just really speak more to how the market is set up from a trading infrastructure, and something that we'll continue to make some improvements with.
Really interesting. Alina, from your perspective, so what is your team doing to sort of, I guess, find, gather, and then make usable all the data that's out there?
Yeah, no, Kevin, and I think Scott hit it right on, right? I think this industry has made, marginal improvements, and sort of we've been, part of it for many years, but in many ways it's still a very archaic asset class. For example, the notices coming from agent banks, right? I think in many ways we as a vendor had to move on from the fact that some, agent banks send them as faxes, some send them as PDFs, text, FPML, you name it, any sort of format known out there. We had to move past that issue and find automation initiatives, OCR, AI, other technologies that would make us just as efficient in consuming that data as if it came as a message. So we really moved past that issue. We're receiving over 18 million agent notices a year, and that process is for the most part pretty efficient. We've also spent a lot of time automating trade settlement process. And we've seen really great success where the front office can send allocation to our systems and the settlement process kicks off right away. And by the time trade settlement physically happens, it's all message based, and the users are not hand keying documents, they're not reviewing them, they're really just managing the exceptions. So we've seen savings of upwards of 6.5 to 7 minutes per trade allocation. So if you multiply that times thousands of allocations that many of our managers do, it's a significant savings, time savings in their workflow. You asked earlier on what types of data are people looking to see. One of the things that's been interesting for our clients is seeing kind of accountability metrics, where they stand against their peers in settlement times, right? Which of their counterparties are doing a better job of settling trades faster? Or maybe it could be an internal KYC process that's holding back significant amount of capital. So we've been focused on delivering those types of dashboards as well to help managers manage that process a little bit better.
And that workflow improvements that you spoke of, did this also impact I guess what we would say, the infamy of the loan market, and that it can take weeks sometimes for trades to settle? Is that something also you're seeing improvement?
No, that's right. That's really been our goal, finding ways to reduce that settlement time. Of course, our outsourcing teams are really even measured by that. So the shorter the settlement time, the more successful we and our clients are. So we're always looking for ways to solve it with technology, but a lot of it is behaviors, right? It's actual behaviors and incentives in this industry that really make us be more efficient. But from a technology standpoint, we're absolutely incentivized to do more.
Great.
If I may, from a data point of view, I would like to distinguish between the public debt and the private debt, because the markets and the technology supporting these things are at different stages. If you compare, public debt with equities and fixed income, yes, it's obsolete, it's slow, the settlement times, are forever. But if you look at the private debt, that's even worse. Okay, not only that there is very little data, it's hard to get, right? So it's from a business point of view, it's hard to manage credit risk if you are in the private debt business, because there's very little information in the market about the borrowers. So this is where technology jumps in and tries to bypass some of these problems by using, artificial intelligence, machine learning, to look in the market to any piece of information that can be collected and brought forefront to the portfolio managers. And sometimes maybe we're going to have to implement something similar to what private equity is doing, collecting financial and operational data from, the portfolio companies, right? So there are varieties of ways that technology can bypass this, but there is a clear lack of data for the private debt versus the public debt.
Yeah, it's a great question. And maybe, Scott, that circles back to you. Can you comment on the flow of financial information with the private companies in your portfolio? How do they make it available? How does that whole process work, and has it improved?
Yeah, certainly. To pick up on Adrian's point, I'm managing what's called leveraged loans or broadly syndicated loans. And these are loans that have public ratings, but that really is the only extent to which they have any public status to them. Now, about maybe a third, 30%, somewhere around there, of the entire leveraged loan universe, which is that 1.5 trillion size market that Adrian mentioned at the top of the webinar, are also public filers. So as is stipulated by Securities and Exchange Commission, financial disclosure requirements, et cetera. But now you have this 2/3, 70% that are all private. And so the information flow there essentially runs through secure deal sites, and there are a handful of secure deal sites. And that financial flow of information is really only made available to those lenders that are recognized as lenders to those particular issuers. So not everybody in the loan market has access to all of the financial information for all of the borrowers or issuers in that market. So one of the key elements to our ability to track our credit positions is to, number one, ensure that we are adequately linked to all of these secure deal sites and that we maintain that linkage throughout holding these credit securities. So we actually have a separate vendor that acts as a gateway for us to all these secure deal sites and is tracking to ensure that we are, in fact, receiving all the information that we're meant to receive. So again, this is something that, to Adrian's point, creates a little bit of an information barrier to people that are not in the industry, that are not active, investors, institutional investors, et cetera. And so that's a key component to ensure that we're able to adequately monitor the portfolio risk.
Yeah, and that sounds like something screaming for automation and aggregation, right? But I know that's always easier said than done.
Yes, true, very, very true. And but again, the innovation behind it has really been impressive. This particular vendor that I refer to is a firm that was launched about 5 or 6 years ago and has really grown tremendously to help all lenders, because it's a shared responsibility, it's a shared risk for all of us. So to the extent there's that commonality that's felt by all of the lenders, all the institutional investors in the marketplace, generally there has been a solution that's been created for it.
That's great. So one last data question that came into my head as you were all speaking. The idea of alternative data sort of came out into the consciousness of the market a couple of years ago. I think it started with the idea that you could look at social media and come up with sentiment, or the idea of taking pictures of parking lots. It almost sounds like in these markets and private markets, maybe most of the data in some ways is alternative that helps you with valuations and risk profiles. Can you whoever wants to jump in, talk a little bit to that? Is there a search for new sources of alternative data here to help with these challenges, or really has the data that's useful at this point already been found and is being put to work?
I can take a stab. I think both to Adrian and Scott's point, on the private credit market, we're still grappling with just gathering the data that we know and love and need to make decisions. So I think from that, we can build private credit indices and other data sources that, again, more liquid markets are used to comparing against. Investor call data. I don't know, Scott, if that's ever been sort of interesting for your firm, but that's something we've heard before as well, where, taking sort of those presentations and sometimes speech of what the CEOs are saying in investor calls and actually transcribing that in a more digitized way. Have you heard about that, Scott? Is that interesting?
Yeah, that's interesting. We actually do here at Putnam. We do have a service. It's not really as applicable to the business that I'm managing, but for the on the public credit side, that is in real time scraping all of these transcripts and any presentation that's put out there, as well as the financial data, and it's looking essentially at some key words and some key themes, whether it be inflation or supply chain or lost reserves or what have you. And it's really capturing that and then rolling it up to a sector level and seeing if there are implications that can be extracted from it. So, there's when we hear the word data, we tend to think of quantitative and numeric figures, but data comes in various forms, and how you pull it together and you create something that can have an actionable follow-on to it. And so it's just peeking a little bit, peeking its head out a little bit into the traditional private credit markets, but certainly that is something that we've seen gain on the horizon.
For every data challenge that we encounter, eventually a solution comes up. The example is ESG, right? A year or two back, who had information on ESG? Nobody. Now, we have vendors that provide ESG information on some of the loan issuers. So, there is an opportunity in the market. Eventually, we're going to have a provider of that data. Complete, incomplete, that's a different story. Accurate or not accurate. But public issuers. You have FinDocs, you can get financial data from them, right? Again, an aggregator, a data aggregator that, goes to different sites and pulls financial data for customers like us. So my hope is that eventually a vendor is gonna show up, and as Scott indicated, it seems that already did, to at least collect and provide some information on this private debt space.
Right. And so we'll ask a negative question, and then we'll ask a positive one as we're getting closer to the end of our time here. Scott, can you tell us what are some of the most frustrating parts about your current workflow? Like, what are the things you would love to see change that just are annoying day to day?
Yeah, well, I think there's a couple of things, and Elena spoke to it a short while ago, and one is settlement times, and I think that the industry collectively has really made a valiant effort to try to shrink those loan settlement times. So what we're talking about is you sell a loan on June 1, and the loan doesn't actually settle until June 18th or 20th or somewhere thereabouts, despite all the technology improvements. And I think that really is reflective of just how many institutions need to touch that train. So that's one aspect of it. The other one is there's because we are a private market, because we don't have loans that have QSIPs and we don't settle through DTC, we tend to lag as far as when data is readily available for a given loan when it's coming into a new fund, right? Particularly with new issues. So a new loan gets issued in the marketplace, we know what the credit ratings are, it hasn't settled yet, it doesn't have an identifier to it, so therefore it's hard to really capture all the data that's relevant and necessary for the investment vehicles that are holding it. So that's something that's frustrating. So we have what's called a loan XID that tends to be like the VIN number for a loan, but that doesn't get generated and dispersed throughout the marketplace. It can lag from when you actually get allocated that individual loan. So there's certainly areas where we'd like to see some improvement, but we're getting by with good individual effort.
Great. Adrian, what about for you and your portfolio managers? What are some of the frustrations you all have? Adrian, I don't know. What are some of the frustrations that you and your portfolio managers have had?
Oh, I'm sorry. Yeah, I was on mute. So we share the frustrations that Scott just indicated. That's generic to this market. The other thing is the idea of data inconsistency, right? So you have different sources of data because we don't have a central repository for all this data not being regulated, and all this information sometimes is inconsistent. So you have to make determinations as to what data do you need to use, how could you use that data, right? Sometimes it's a business decision. We try to build algorithms to do that on behalf of our users, but in the end, I would say that probably 50% of these issues of data inconsistency need to be addressed by direct involvement from the portfolio manager, which is frustrating for the portfolio manager, and it delays what would like to think to be almost like straight-through processing for loans. That's the ideal world that we want to be in.
Right. And Alina, of course, you and the team at S&P are working to solve all of these frustrations.
Naturally, all of them one at a time. No, but really the goal of real-time data is really connecting those who need to make immediate action on that data. Right? I think it's easy for us to get overwhelmed by the amount of data, whether it's transaction, trades, about the individual borrowers in the portfolio, their financials. But I think we have to step back and say, okay, which data is relevant for which decisions? Who are the consumers of that data? Are those consumers able to consume the data in a real-time basis? So we really have to take a pragmatic look. But I think this industry is built on that incremental evolution, and we'll continue to make strides there.
Yeah. I mean, I guess that's a good way to sort of take us towards the end, thinking about sort of the outlook for the next 18, 24 months, not about the direction of the economy or interest rates, but the infrastructure for the loan market. There's been a number of sort of new firms launched over the last year that sort of look to add more data, more electronic trading into the loan space, for instance. A lot of talk over the last several years about the idea of using distributed ledgers, maybe to help with settlement, for instance, having nothing to do with the issues in the cryptocurrency market. So yeah, I mean, I guess we'll start with Scott, and then maybe we can just sort of go around the table. Yeah, I mean, what are your expectations for some of these initiatives and sort of the market improving its efficiency, in the next year or two?
Yeah, I'm certainly hopeful. There's been, just this past year, announcements of new online trading capabilities where we've got a consortium of banks, the major trading banks for this asset class, looking to come together and just create more transparency, which I think can really upgrade our ability to provide price transparency to everybody in the marketplace. That helps build trust, which is always a key factor for any financial asset marketplace. So I think that's going to be a really nice development. It's but I think that we're always going to be somewhat limited or maybe restricted by virtue of the fact that we are a private asset class at the end of the day, and there's upside and downside to that. I think the downside is that we'll never get to trade as you do a investment grade bond, or certainly not public stock. The benefit is we provide access into investable assets that isn't readily available to a lot of certainly retail investors. You can't go on to your brokerage account and buy the debt of a lot of these companies, right? So because we are a private asset class, so that our expectations for it, as much as we'd like to always see continual improvement, are really limited by that factor.
Great, Scott. Alina.
Yeah, no, for sure. The fact that the asset class is private, will continue to present challenges. But I think we'll be looking to gather that data regardless and anonymize it so that it is readily available to the participants and providers to this industry. So I think that's one way we're looking to sort of get away from the fact that the data is generally not private. Our focus in the firm from sort of the next horizon is really focused more on the front office capabilities, where we've partnered with a strategic, we did a strategic partnership with a company called LevPro. It's actually was started by CLO traders who sort of felt the pain in the industry with incumbent providers, and really, putting together workflows from order management, new issue calendar, and bringing them closer to the middle and back office processes. We think that's going to be pretty transformational for the industry. There's a lot of cool technology being used that helps the front office communicate better using various AI tools, tagging mechanisms. So we're really excited about going into that space now.
That's awesome. And Adrian?
From a technology point of view, what I see happening in the industry, and in working with my peers at other organizations, is that as we moved into the cloud, and we don't have to worry about the infrastructure for applications. I think the next step is to take commodity services out of the technology organization and have the vendors deal with them. We want to move to managed solutions where the whole technology stack from infrastructure all the way to the application is managed by a third party. So the few resources that we have can focus on improving the data quality. Data, as was highlighted here, is a big topic, and also leverage other technologies like artificial intelligence to be able to enrich this data.
That's great. Good. Well, lots of hope for the future. We touched on some great topics. We even managed to talk about cloud and artificial intelligence before the end, so that's always a plus. But no, in all seriousness, thank you all. It was a really great conversation. Fascinating market, both from an investing macroeconomic perspective, but also obviously from a technology and a workflow perspective. So lots to keep an eye on, as we head into 2023. So thank you all again for your time. Thanks everybody for listening, and please do fill out that survey when we wrap up. But again, thanks everyone. Have a happy New Year, and we'll look forward to following up on the conversation next year.
Thank you very much, Kevin.
Thanks, Kevin.
Thank you.